Afternoon, everybody. Welcome to today's edition of the Boutique Manager Showcase Series, presented by BX Capital. Today's edition features Charles Helmy, the portfolio manager for a number of BX Capital portfolios, most specifically the large cap growth portfolio, which we are going to focus on today. Just as a quick reminder of what BX Capital, the firm that we represent, hosting the call does, amongst a number of other things. We do due diligence on hundreds of boutique money managers out there, kind of doing a lot of the legwork for you. And we find a select few that we think are really noteworthy and worthy of significantly more attention. Then we work with them to make them available on more platforms more easily to you, and then work to get out the word about them to you. One of those platforms that these managers are now going to be available on is our very own customized asset management platform. Really sleek technology. If you haven't seen it yet, there's a number of really good managers available to you there. You can get a hold of us and we'll sign you up for a demonstration. Love to get that in front of you. But without further ado, what we're here to talk about today is the BH Large Cap Growth Strategy. So with me is Charles Helmy, the portfolio manager there, and Arun Kaul, the CIO of BX Capital. Arun is really responsible for spearheading all the due diligence efforts amongst all the other investment management research functions here at BX. Wanted to bring Charles on today. I'm a simple guy. I think that the numbers are extremely noteworthy. Just looking at the portfolio over a 10-year period, more than 750 basis points better than the S&P on a gross basis. Really impressed me because it wasn't a one-hit wonder. This is consistent rolling out performance, which I think is noteworthy. Just as an idea of what that can do for you, $100,000 10 years ago in Charles's strategy would return you over 700 today. Whereas the S&P 500 has had a fantastic decade, you'd be left with just over $300,000. So really compelling returns. So with that, I wanted to get Arun on to kind of have a conversation with Charles about how they run the portfolio, what they see going on in the markets, and what the advantages of this strategy right now might be. So with that, Arun?
Great. Thank you, Chris. Thanks so much, and welcome everybody. And thank you, Charles, for joining us today. I thought we could start out, we'll take about, 30 minutes today and go over your strategy. So we can start out with maybe touching on your philosophy and your methodology. Then we can move on to talking about the market environment, some of the stocks you're looking at, specifically what you think about some of the valuations in terms of growth and growth versus value. Maybe touch on some macro issues as well, and get some of your fearless forecasts from you looking forward. But maybe just to start, we can give a little bit of background just on the philosophy of the strategy for the growth strategy, and just how that ties into some of your methodology.
Well, thanks very much for inviting me to present. The philosophy is pretty straightforward, easy to understand. We invest in high quality, sustainable growth companies with superior managements and compound their growth at high rates. So they're real businesses that are established. Their companies are high quality, meaning they have growing free cash flow. So things we don't do is we don't buy IPOs. We rarely purchase companies that depend on markets for financing. And that means we don't own the top stocks like Virgin Atlantic. We didn't buy Amazon or Netflix. And we don't own one-trick biotech stocks that have been the screaming winners in this market. Why not? Well, for each high-risk 10-bagger that you might find among the thousands of companies out there, there tend to go to zero. So we don't buy moonshots. We also try to avoid untried managements, and we want to avoid them because anyone who's willing to take a flyer on a company that may not be around in 5 years, I don't want to trust with my clients' money. So that's important, and only because we take concentrated positions. So we typically hold just 20 stocks, and closet index. Anyone can closet index and make out, 1 year or another, and be generally successful at gathering assets. But we're trying to do better for our clients. So we try to eliminate all the best opportunities, and those are mostly they're undervalued or misunderstood companies that may have recently fallen out of favor or forgotten, but are about to revive. And that could have been Apple 2 years ago, or it could have been Microsoft a couple of years ago. Both of those companies were out of favor and left for dead, but we doubled up on them in the end of 18. So we like companies with great businesses that may be getting rid of a low margin or an inferior business, or maybe they're going temporarily through a soft patch on a major product launch and investing a lot. But the result of that is going to be a permanent change for the better.
All right. And can you maybe just touch on some specifics? You mentioned free cash flow. You mentioned, I guess, potentially turnarounds or rising margins. Is there a pressure that you see is more important in terms of returns on invested capital, free cash flow, dominant position, anyone that you rank higher than the other, or what are those other key parameters that you look at?
If you run a back test on any strategy, you can see that high ROE wins out by far as the strongest criteria, and that's our primary criteria for investment. So you have to have a high return on capital, high return on equity, and recently our emphasis on the high revenue growth rate has been a major winner.
All right.
On the other hand, dominant or disrupting the market position relative to competition has also been a market leader.
Right. And are you looking for those type of firms with higher revenue growth to also have the higher ROE, and for the disruptors to also have the higher ROE, or will you sometimes make a trade-off in that area?
We rarely subordinate the ROE to the revenue growth rate because these companies are established. It's usually a sustainable or long-term superior ROE. It's not just the trailing 12. So you may find companies, like Zoom, that after flatlining for a decade, they all of a sudden just take off and they've got, 100% revenue growth rates. But that's going to be a different company in a year from now than it was a year ago. And it remains to be seen whether management can manage through that kind of explosive growth.
Sure. No, fair enough. And I guess you mentioned real business that compound over time and you avoid IPOs. Is there a general time frame when you would start to enter a stock in terms of after its IPO, or in terms of creating a real business content, or is it profit? Is it ROE? Is there a time frame specifically? How do you sort of look at that demarcation, especially today we've got so many of these higher growth names that are shorter track records, but obviously have a lot of high top line and high top revenue growth?
So we like to see sustainable growth through a business cycle or through a market cycle. That means that most of these companies have access to the investment grade debt markets, and many of them have, investment grade ratings. So what happens is if companies get over their skis in a very rapid growth environment and they lose it, then they try to go to the market and they can't actually raise money. They've got to go to the convertible bond market, do a big dilutive offering, and that hurts investor value beyond the fact that the stock has cratered.
Right. Fair enough. All right. Maybe we could just move forward to some of your thoughts on the market this year. I think you've described the market as feels like we've been through maybe 3 different markets so far this year. Maybe you can give us an idea of what the portfolio looked like prior at the beginning of the year, January, February, drawdown? Has there been any changes kind of post March? What did you do and why did you make changes?
Well, I would say that we've been through 3 or 4 markets since the beginning of the year. When I thought it was impossible to do better than last year, we were up, 42%, and we had a couple of 30 and 40-year numbers before that. So we took a lot of growth assets and thought about what was going to be successful going forward. But pre-COVID was very much like now, with growth and momentum far outstripping value names. Right. At the same time, there were concerns about China versus U.S. trade dominating. And we thought straight up winners like Apple and Microsoft, like now, were probably ahead of themselves. And we started trimming winners at the same time we were expelling losers from the portfolio. So back when the market was making new highs in January and February, we were taking profits in financials and reducing, anything or anything that was energy related. But it rolled over pretty quick from February to March, and in March, we actually started buying too early. A lot of, like, the buildings products companies and other cyclicals took a dive and were down 40 or 50% in 2 weeks. And we thought they'd do okay despite a couple of quarters of COVID. I don't know if you remember back in March when we met to review last time, just before the lockdown, I told you I expected a V-shaped recovery and was positioning for it. And we were buying every day, and I think the market bottomed within a week of that meeting. And we added some great exposures down there that positioned us completely for the recovery. Both very cyclical names, like I just mentioned, and also the big growth names. We were buying like the Cienas and the Marvels, the 5G guys, because we thought it was going to be at least a year before earnings would come back, and we wanted to be, sort of hiding out in 5G because nobody was expecting 5G to come on until late 2021 or beginning of 2022. So we looked out with getting into some of those names. We also bought some changing company names, company like Elanco, which is the pet food business, and HD Supply, which is the company that supplies all of not only Home Depot stores, but also their competitors with do-it-yourself and contractor supplies for everything from tile to lumber. But back in June, we saw another change in the market, and maybe we sold a little too early, with many of those more cyclical names doubling from the bottom. But we thought that they had probably gone too far too fast, and we were looking to get into names that were not as cyclically exposed. And we also continued to trim the high flyers like Microsoft and Ciena. Fortunately for us, in the case of Ciena, because after Cisco disappointed and warned on enterprise spending in August, middle of August, on their earnings call, and the stock cratered, you got a feeling that things could get rough for tech companies going into the fall as spending, flatlines with fewer folks going back to the office, and enterprise budgets probably being trimmed. We had originally swapped out of Cisco into Ciena a couple of years ago to get that higher growth from the smaller company. And it ends up Cisco's pretty much flat after 3 years. It's back to where it was when we sold it.
All right. So why don't we just let's take kind of where we are today, I guess, and maybe touch on those two areas you just brought up. So in terms of some cyclical names having had a fairly significant bounce, and now that we're seeing maybe a correction of some of these growth names, do you see this persisting, or do you see this an opportunity to go back into cyclical names, or how to look at it from that perspective in terms of some of the value names, some of the cyclical names, and some of the more pure growth names, given what we're seeing now?
Well, after Tesla and Apple split, and then Tesla the same day or the next day announced that they were going to do a $5 billion secondary, that pretty much did the start out of the rally. And it was that same day when actually Ciena reported that orders were going to be light, despite better than expected earnings for the quarter, and they guided down for the rest of the year. So that negative sentiment has put in a pretty good correction in the broad indices, and led by mega cap tech and many of the high flyers, we see some rotation going on here, and we expect that's going to continue, but it's going to run its course over the coming weeks, provided we don't see further shocks on the political or the trade front.
Right.
In fact, after reducing by 2/3 or more our Ciena position near the highs, we recently started nibbling to replace the sold shares. So anybody that was able to trim some of those high flyers at the top now have an opportunity to buy stuff 20% lower.
So are you seeing this action now as more of a profit taking, or the beginning of a larger correction, or what are your thoughts in terms of how you're seeing some of the stocks behave?
Well, I mean, it was definitely ready for correction. People were pretty surprised it was going up every day in August, and they were just like, I'm glad I'm at the beach. But earlier in the year, we also sold other growth names like Starbucks and Nike, which have been recovering with the Chinese economy, as well as more cyclical stocks like Intel and stuff that are still a lot lower. So we think that there's plenty of companies that meet our criteria and that are strong candidates for continued gains, where we can put money to work in this market, even as the rotation continues.
All right. Interesting. Why don't we I'd love to just drill a little bit deeper into some of the growth names or some of the valuation differences with regards to your methodology. So when you look at some of these names, like you mentioned a few, a Ciena or a Microsoft, which on face of it still seem like they might be expensive. And of course, we have a different subset of names that are even more expensive in terms of Zooms and Tesla and Shopify. Maybe give us an idea of how you sort of look at the valuation, or how you would say that Microsoft is still a good value, or Ciena is still a good value, given her global payments might still be a good value, even though they're expensive. How do you have to look at that in the context of the overall market today, with valuations being spread so much across a lot of these names?
Well, remember that the market is still looking at earnings in 2022 as baseline. They're not looking at 20 earnings, and some have already reported, fourth quarter 2020 earnings, and they're going to start next quarter with 2021 Q1. So a lot of estimates you have to look at in 2022, and if you're looking at Microsoft in 2022 at 27 times, yeah, that's up from 18 times 2 years ago, but interest rates were at 3%, and now they're at 1 or 0, and Microsoft's still going to report 11 or double-digit top-line revenue growth the next couple of years, and they own the cloud space, so not just in the U.S. but all over the world, they are the cloud computing hoster of choice, and we think that's that's worth a discount to the market multiple, which is where it's trading.
Right. You think
Because the stuff like you're talking about, that other stuff's trading 50 or 100 times earnings, and in many cases it's trading at 25 times sales or more, and it's going to take forever for them to grow into those multiples.
Right. It seems like we have some shades in 1999 potentially with some of these relative valuations where everything looks relatively well priced against 35 times sales for Zoom or Shopify.
Well, it's not just there. It's also in any consumer name. So you look at, we like a company called Elanco. It's an animal healthcare stock we just bought near the lows, last quarter, and shares were trading at steep discounts to the normal multiple, but in a great business where they were closing their deal to purchase Bayer's animal health business, which is a global business, not just companion animals, but also farm animals, equine, and everything else.
Mm-hmm.
If you look at their senior management team, they're all rapidly snapping up shares, doing insider buys, whereas Chewy, which is usually named as the hot stock around town, it's got double the market cap. Their CEO and their CFO have been selling shares hand over fist. I think Singh just sold $4.5 million in stock, and the CFO just sold maybe half as much. But they just IPO'd a year ago, and the company's got significant growth challenges. And I look at Elanco. They've got 35% revenue growth. That's nothing to sneeze at, and they're trading at 21 times fiscal 22 years, and they only 13 times cash flow. So, I mean, those are real numbers for a real business. It's a global business. It's been around for a long time, and I have a higher degree of confidence in owning them than Chewy. Unless, of course, you just saw the earnings. Did you just see the earnings go past the tape? They were supposed to have a big. So I'm turned away from that. There were pretty high expectations for Chewy's earnings. It still would have been a sale on the news, I think. But
Right. That's
great. I don't have lots of companies.
Okay, I got some pretty good insight into your stock and your methodology. Maybe we can just, as we get ready to open up for questions, maybe we can just comment a little bit on some of the macro issues or bigger picture issues. You mentioned, I guess, China and stimulus. Do you think between the election, China trade and stimulus, do you have an opinion on which one is the more relevant issue for markets? And are you making any adjustments based on potentially any one of these scenarios that you see with these larger issues?
Well, I think the market's going to be disappointed with no stimulus. You saw the sell-off today just because they couldn't get a $300 billion, Senate bill passed. But that's going to be an issue until the two parties can come together and print a stimulus recovery act, and that rancor's going to continue into the election. And China trade issues are now politicized, so either side of the aisle is going to be anti-China and make things very difficult to get any kind of trade bills printed. So I think some of the macro bigger issues, while the election may already be discounted. I think China and the stimulus issues have room for disappointments.
Right. And are you trying to stay away from some of those issues, some of the names that you're looking at, or do you feel you might make some adjustments potentially going forward in some of these issues that don't break the way you think they might break?
Well, I'm trying to find companies that are going to win either way. So Ciena is definitely a Huawei beneficiary. If they put Huawei out of business, they're going to benefit. Juniper, which we recently bought after we sold Ciena up to that $60 level, and only sold off a little bit in this recent downturn. They're going to be a major beneficiary. The CEO was just at Citi's virtual technology conference presenting yesterday. I'm very confident that sure of himself and their technological advantage. So I think they're going to be winners no matter what. We also own Nokia in our international strategy. They're obviously going to be a big beneficiary of China trade issues with regards to the fight for 5G dominance. So
right.
Our other big position in 5G, Marvell, they're also definite beneficiaries. The stock is held up throughout this whole sell-off because everybody knows they've got the technology that is going to be necessary for the rollout.
Right. Okay. Very interesting comments. Interesting how they tie to some of the macro issues. Maybe we've kind of come up towards 30 minutes. I can pass it back to Chris. Chris, if there are any questions or if you have any questions you want to follow on at this time.